problems. And so I graduated from Stanford Business School in 2005. I had my own kind of Google-ish idea, which was, let's see how we can innovate in providing products to those that are underbanked and unbanked. And what we focused on was how can we make the biggest social impact? Well, if we can help people build credit scores, then they can really improve their livelihoods and their future financial potential. We found there's a lot of hardworking people, but they just didn't have a credit score, so they couldn't get access to a good loan, couldn't get a bank account, so on and so forth. So started Progressive 2005. We've now made about 240,000 loans, all in the $250 to $2,500 range. In California alone, this past year we made 135,000 loans. 135,000 loans this past year in total. 115,000 of those were in California. We're now in California and Texas. We have about 90 locations. We're primarily in supermarkets. If you go inside Latino supermarkets, we'll have a Progreso Financiero booth there, and that's where you can find us. So most of our borrowers are $25,000 to $35,000 of income. Their reason for getting a loan is because they want to build their credit. They also have an emergency they want to fund, or sometimes it's small business or some auto-related capital expenditure that we're funding. We are, I would assume we're now one of the largest lenders under the CFL for loans below $2,500. Our biggest challenges in building the business, we've now raised over $100 million of venture capital since we've started, over $200 million of credit lines. We've made over $250 million of capital available to low-income communities. And we were certified as a community development financial institution by the U.S. Treasury in 2009. Our biggest challenge has been, it's hard to make money on small loans. So frankly speaking, is profitability. We're still not profitable. We're almost there, but it's been a long road. We believe in providing a fair product to people, but providing a fair product and making money has been something that's been challenging. The other side of it is where do we get all this capital? Since we're not a bank, we're going to lend out. We've lent out $240 million. Our plan is to lend to underbanked communities $1 billion. Where are we going to get $1 billion of capital, especially if the securitization market is not working so well? So those are our two biggest challenges. As we look at California, and the graphs that we handed out here is sort of, it says California dilemma. There's a lot of demand for small loans in California, but as you can see, the distribution, 12 million of those loans were payday loans. 200,000 of those loans were for CFL loans below 2,500. So in 2010, working with Senator Flores, we said, look, this is a dilemma in that there's not a lot of competition or price competition in the market. So if CFL lenders are only doing 200,000 loans and there's 12 million payday loans, there's not a lot of people putting pressure on pricing and trying to provide alternatives to payday. And so we felt that the reason for that is there's a problem in the law. And the CFL law was too restrictive and needed to be amended so that there could be more credit-building opportunities for the underbanked. So that was sort of the impetus behind the law that was passed, the pilot program. And one other thing I wanted to let the members know is when it comes to the unbanked, there was a question earlier, I think, from Assemblymember Calderon, which was banks are not lending to this community. That's right. Most of the people we lend to don't have a FICO score, or they have a FICO score of 540. So if you go to a bank and you come in with that kind of credit record, they're going to say, sorry, you're declined. Better luck later. So, and that's what's happening to underserved communities, whether they're ethnically underserved or they're just low income. And California, with high unemployment right now, it's tough. So banks don't make these loans because when they go to their regulators, the regulators say, the way I measure risk is FICO, and if you're lending to somebody with a 540 FICO, I'm going to shut down the bank because it's too much risk. So therefore, banks don't do it. So it's really only the non-banks, the payday lenders and others like us and others that are actually serving this community and providing access to capital. The other thing that's happened is what Paul Leonard was talking about is that credit cards have taken over the small loan market. And to the example, again, of Assemblymember Calderon, they may send you a 15% APR offer, but that APR does not include the fees. So we have to, for example, when we quote a rate, if we say 36%, that's a 26% interest rate, and then the origination fee that's combined to include a 36% rate. Credit card companies will only tell you the rate part, and they don't combine the fee part. And so they're also able to get federal preemption, and they can bypass California law using an Arizona or North Dakota bank. So since we have to abide by California law as a non-bank, and in every state we lend and get a license in Texas and Illinois, et cetera, we're restrained by these price caps that exist in California. So now let's move to the law and the questions about the pilot program. So basically our idea here was, look, let's do a two-sided solution. Let's do something that's good for industry so we can get more competition. We want to get more innovators in the market that are going to provide a good offer to consumers. And then let's also figure out things that are good for consumers, like you have to report people's performance to the credit bureaus so they can build credit, establish credit. Like you have to do good underwriting, to what Paul Leonard had just suggested. We increased the numbers a little bit. So if you go to page 2 on this, you get a graphical interpretation of sort of the old law was on the left, and the different colors here are different terms of loans. So if you have in the blue, if you have a very short-term 3-month loan, obviously the APR is going to be a lot higher. And this is, down below you have loan sizes from $250 up to $2,500, where then the law changes. So what the pilot program did was basically change the left picture to the right picture, and those are the new APRs when you include the fees. So interest rate plus fee, those are the APR caps depending on the term of the loan and the size. So how did this impact us? As I just heard from the commissioner, I was surprised to hear that so 3 applicants for the pilot program. We thought it was a great idea. The whole idea was to get more competition in the market, increase access to capital, yet only one licensee has passed of 3 that have applied. So we were approved. I would say kudos to the DOC. They did a good job getting the program out very quickly. We applied once it was available, and we've been using the program for this year. So what's the impact on Progresso? Slide 3 here. Our average APR used to be 34%. Now it's 36%. So we got a 2% increase in pricing. That was very helpful. To take advantage of this, we increased our average loan size from $1,000 to $1,200. So that's reflected there. Overall, though, for the year, it still has a very marginal impact on our profitability. We were only able to get $1 million more of revenue as a result of this program. So at the end of the day, as we look at it now, what went well, what didn't go so well, I think, a potential failure, not failure, but an improvement opportunity is that there's only three applicants, and there's only 1 that was passed. So we need more people in the program, and I would suggest that there needs to be some amendments made. Other things is that on the pricing we would argue is actually still a little too restrictive. And keep in mind, this is payday loans is 400% APR, and look, we think access to capital is good for everybody. So we would argue that that they have a place in the market, but there should be competition. So with this restriction, even under the new pilot, it didn't go far enough, basically. And so our proposal would be that, 1, it's a pilot program, it should be made more permanent or increase the life of the pilot. But we would propose to increase the cap on origination fee from $65 to $75, increase the interest rate that's from 0 to 1,000% from what's currently at 30%, increase that to 34%. And then from 1,000 to 2,500, it's currently at 26%, increase that to 28%. So we're talking about 2 to 4% increases here that are very much on the margin, but very much needed to have more people actually enter the market and provide loans. The last thing is sort of a crazy idea I'd like to share with you on how do you actually get this problem solved. So you have a lot of low-income people in California. They're not getting access to capital, at least not from banks. They need access to capital to fund a lot of their needs and really for the economy to grow, in addition to more employment. The problem is that when you're a startup, let's say like Progresso, and you're growing those loans, you need to have a lot of scale to make this business work. Because, of course, Assemblywoman Harkey was saying, she was absolutely right, the cost of a loan, if I provide a $100,000 loan or a $1,000 loan, is the same cost. The cost is not proportional to the size. So if you're doing a small loan, it means your APR is going to be a lot higher to cover the dollar cost associated with that loan. And so it's very hard to make money on small loans. And as you're trying to innovate, what we would recommend is there should be some form of, you have these carbon emissions trading credits. Well, why can't you have tax credits that we could trade to companies that are profitable, and we could get money in exchange when they buy those credits from us for doing what's kind of a social good until the point that we're basically profitable as a business. So that's kind of a bigger change and a bigger idea. But, the reality of the situation is that Progresso has had to face it many times in its history. So we now employ 600 people. We've grown a lot from the days when I founded the company in 2005. And we've had to face the fact that we may not be able to make it for the following month because, we're still relying on venture capital. We're still losing money. And we believe at some point we're going to turn to a positive, like Amazon and other companies that did that, and the innovation and the employment we're creating in California and in Texas. But basically, the business model of doing small loans is extremely difficult, especially under these restrictions. So, frankly, there needs to be some additional changes. And at the end of the day, when a consumer sees a price of a 26% rate plus an origination fee, which is a 36% APR for a $1,000 loan, so the math is I lend you $1,000, you pay back $1,200 over 10 months. So your dollar cost is $200. That's a pretty good trade for a lot of people that are lower income, and they also can build a credit score. And so what we want to do is proliferate the market with more of those good options, but frankly, there needs to be more changes in the pilot program to do that. So I wanted to make it brief. That's a quick summary. If there are any questions, I'd be happy to answer them.
Okay, we'll take some very, very brief comments, and then we've got to run into the next hearing. Yes, Mr. Morrell.
I just have a quick question. Give me a couple of reasons why you haven't been profitable. Is it repossessions are high, accounts receivable? What?
Sure. So we do only unsecured loans. Yeah. So we're not doing any auto title. It's all unsecured from $250 to $2,500. So very small. They're all installment loans. So, like for example, we lend you $1,000. You have a payment every 2 weeks of $60. You have 20 of those payments. You pay back $1,200 over 10 months. So that's kind of the structure. The reasons for our cost side, the biggest cost is, especially in the underbanked market, they want high touch. So they want to be able to see someone's. People that are underbanked don't have a lot of financial education, need that relationship. So that means personnel cost and labor. And certainly the labor laws in California are not, I would say, the easiest relative to other states. And so you have a lot of you have a lot of costs associated with that. And so that's part of what we call acquisition cost to bring it on a customer. It's huge.
It will include locations too.
It will include the cost of locations, all of the people, all of the underwriting costs, but it's largely a fixed cost of people. We've innovated a lot bringing that down, but frankly, with all the innovation we've done, it's still high. We've combined technology, we're in Silicon Valley, with the high touch and tried to do that. The other cost is servicing cost, the cost to collect, and then funding cost. Since we're not profitable, we have lines of credit with B of A and Silicon Valley Bank. They've been great partners, and others. But we also have a hedge fund who's lending to us at 15%. So if we're borrowing money and we borrowed $85 million from them at 15%, you can do the math. It's very hard. Well, why are we having to borrow at 15%? Well, it's not because our credit losses are high. We're proving that this customer base is actually pre-prime. Their credit losses are equivalent to prime, so they're really good. It's because we're unprofitable. And if they're making a loan, and even though it's secured by our assets, all the loans we're making, they still deem it to be higher risk, so we have to borrow at 15%. And then finally, it's losses. But for us, losses have been in the single digits, and we've been proving that the population that we're serving are actually very credit worthy and pay very well. So for us, it's acquisition costs, servicing, and funding costs are the largest costs.
Thank you, Mr. Vice Chair. Do you want any closing comments on this?
And again, for my apologies for having left and due to other commitments, and I have to leave again for another commitment. Apologies to Assemblyman Dickinson if I'm not here during the time that we need to vote. But in a sentence or two, if you were to summarize this bill, how would it impact? Obviously, there's a demand that you're in business to supply the needs, and probably you're the last resort because somebody needing $50 going to a friend or a family before they're going going through the process that you have in place, and I know it's not a pleasant one, not because of you, but just the idea of going through. How would it impact your business?
How would what impact?
The bill that we're going to discuss in a little while.
The title lending bill. You know, I actually haven't reviewed it, but we don't do title lending. So
you're different lending.
So what we would propose, Mr. Vice Chair, is amendments to the pilot program bill that was passed in 2010, which was SB 1146. At the time, it was called that. That there be a new bill to amend that bill, or to amend that law to make it better.
Okay. So
it wouldn't be a comment on
what we're going to discuss in the upcoming bill, that whatever happens there has no impact about your capability to loan out or the amount of rate you can charge.
We would propose that there be additional amendments to the existing pilot program. As regards to the auto title lending bill, we don't have any comments on that
No
bill.
connections. Okay, thank you. My misunderstanding.
Thank you very much. And if there are no other comments, that's an excellent way to close that. This pilot program that started off, I'm not sure whether there's enough of a track record, but you could make the argument either way that without an amendment, you'll continue to see a rather low level of participation. And so it's the chicken and the egg. But we'll have that conversation. I'm sure that if there's legislation, you'll be in touch with one of the legislators. I want to thank everyone for participating today. Apologize. We have a hearing coming up, and we'll have more comments to make afterwards. If there's anyone that wants to make a comment about the hearing, we're going to postpone the public comment until after the hearing on the instant bill that we're going to be discussing right now. So at this time, we'd like to call the absent members to the Assembly Committee on Banking and Finance. That would be Mr. Calderon, Ms. Torres, Mr. Perea, Mr. Lara, Mr. Fletcher, Ms. Harkey. If you will come, and if the sergeants can also help me call the absent members. I'd like to ask Mr. Dickinson to come up, and thank you for your patience. Apologies, but we did kind of target this for around 4 o'clock, and so we're just about a few minutes off that target. And as you can tell from the previous discussion, there's a lot of interest in your bill, and a lot of interest in the concerns that were raised this afternoon. So without any further ado, if you'd like to welcome to the committee and present your bill.
Thank you, Mr. Chairman, and members. At the outset, I want to thank you, Mr. Chairman, and the committee staff for working with my staff and me over the intervening months since we last met to this new year on this, I think, important but complicated issue to be sure. And I want to compliment your staff for, I think, having provided a very good analysis of this bill for the benefit of the committee members. Let me say at the outset there are several amendments that have been suggested by your staff and which you and I have consulted about, and I am prepared to accept those amendments as authors of amendments as detailed in the committee analysis. Let me, in the light of the hour, try to be brief. I think you heard testimony which, while it ranged over the landscape with respect to the consumer finance lending law, certainly did provide a background and information regarding auto title lending, which is what we're talking about solely with respect to AB 336, auto title lending. So let me try to make a few, hopefully, germane points about the bill and about auto title loans. These are loans which are not explicitly authorized under the law. They exist, in fact, because they're not explicitly excluded under the law. They are subject to no interest rate cap if they're above $2,500. And as this committee knows, my bill started out with an interest rate cap after listening to testimony and considering members' views. The bill's been amended to delete the interest rate cap. These loans are apparently growing at a very rapid rate. If I understood the testimony today from the Commissioner of Corporations, if we look and compare the data from 2009 to that of 2010, it appears that these types of loans, these auto title loans, have grown by about 50% in the span of 1 year. The fact of the matter is, with these loans, the risk is virtually entirely on the borrower. The risk is entirely, virtually on the borrower, who takes the risk of losing their vehicle for which they have signed over title to the lender. The lender, on the other hand, takes virtually no risk. No risk. First of all, the lender has title to the vehicle. So they have loaned money at something which typically is between 50 and 65% of the value of the vehicle, which if they do in fact end up repossessing, they can sell the vehicle at auction, recover their principal, and recover their costs of disposal. And by the way, if they accrue costs during the course of a repossession, those costs are added on to what they recover before any surplus, should there be one, is calculated and returned to a borrower. So in fact, in those instances where a repossession does occur, the fact of the matter is that the lender has already recovered principal and interest to the point of default and repossession, and then recovers the balance due plus costs in the process of the repossession and the disposal of the vehicle. There is virtually no risk to the lender because, as we've heard testimony today, there are repossessions by industry estimates in only something on the order of 5 or 6% of instances of these loans. There is virtually no risk to the lender that the lender is not going to get paid and is therefore going to proceed to a repossession. And the rate of default, I would suggest to you, is higher than the rate of repossession because what happens is there's a default on a loan, and then the threat of repossession is communicated to the borrower, who finds a way to reinstate that loan and in one form or another cure of that default, not without significant cost to the borrower. So we have loans that are made typically at a very high interest rate compared to other forms of lending, with virtually no risk to the lender. And all AB 336 attempts to do is to make sure, boiled down, that a potential borrower, a consumer, has as full and complete information as possible before entering into such a transaction, which can be extraordinarily expensive. In fact, we've discussed here complaints made, but only to the Department of Corporations. And it seems like a small number of complaints. But if you go to the Internet, you will find replete across the web scores after scores of complaints that have been registered by consumers who've taken auto title loans. And I don't want to spend an extraordinary amount of time here, but just to give you an example, one, I foolishly took out a $2,600 title loan against my 2002 Ford pickup truck, done to prevent my home from going into foreclosure. I was so desperate at the time. Good Lord, what a mistake. Almost 97% interest. I've given them $1,000 already. I called them to get the payoff amount. I was informed it was over $2,700. That's the payoff. That's not going to term on the loan. but it is reflective of what we see time after time in what happens to consumers. Now, this bill also includes a non-recourse provision in it. And the opponents have said that's not fair. We have excess costs. We should be able to have recourse. But they do have a secured loan for a vehicle which is worth far more than the amount of the loan they have made. And just as we have done with homes, where we have said there'll be no deficiency judgments and no recourse, it seems only reasonable to leave a consumer who has been subject to these terms and circumstances with not being continually followed for more money. The non-recourse provision is a small one that gives a limited measure of protection to consumers about the ultimate consequences of having taken out a loan with extraordinary interest rates and high risk. So in the end, Mr. Chairman, I think what we have arrived at with your committee, staff's assistance, and your good counsel is a bill which allows this product to continue to be used as widely as those who might wish to provide it care to, but at the same time gives consumers a small measure of additional protection. And I would respectfully request an aye vote.
Thank you. Any witnesses in support?
I'm in support of this. My name is Sedaria Lewis, and I currently reside in Oakland, and thank you for allowing me to speak. I want to thank the Assemblyman Dickinson for authoring this bill as well. I lost my car to 1-800-LOAN-MART a few years ago after going into their office seeking out a $3,500 loan. I spent over $37,000 cash for my 2007 Lexus, and had been going through the payday thing and was told about the loan against your title. And like I said, I took out a $3,500 loan and lost my whole car, repossessed and totally gone. I was told it was only going to cost me like $515 to pay this loan off, because had I known it was going to cost $13,000 and $500, I never would have agreed to the loan. I'm disabled, and I used my disability monies to purchase that vehicle, which I thought would last me for another 15 or 20 years. But today I'm still carless. They tried to entice me to borrow more money, but the more money that there was being offered, the more cost was being offered, so I refused. I thought $3,500, $500, and $15 wasn't a lot of money to have to pay back. So I agreed and signed on the dotted line to miss a couple of payments, a payment or a half, and have my car repossessed without any warning or any knowledge. And even when they repossessed my car, there was no information given to me of how I could get my car back. I was told I had to pay off the whole entire loan, which was $13,000 now, opposed to $4,500. So that was new information to me as well. So I support Mr. Dickinson in this bill. My payments were about $383 a month. I received disability income of about $800 a month. And I had recently lost and I had just spoken to them people like a couple of days prior to them coming out and getting my car. So I wasn't even expecting them to be coming to get my car. I was in transition of moving from Southern California to Northern California. So they made it look like I was trying to run off with the car or something. I don't know. But that was their excuse, their reasoning for taking the car. But they never gave it back and never afforded me the opportunity to even get the car back. And then they sold it for under market value and sent me a small check for about $9,000. And the car, like I say, was worth probably $25,000 or better. And I thank you all for letting me share.
Thank you. Any other witnesses in support?
Thank you, Mr. Chair and members. Rosemary Shahan, President of Consumers for Auto Reliability and Safety, and we are in support of the bill. We would ask your aye vote. We see this as a very sensible compromise measure. A number of the provisions just have to do with openness and transparency so that consumers can be more aware of the charges that they're getting into. And from what we hear from consumers, a lot of times they had no idea that the interest rate was as high as it was. That's a surprise to them. So for whatever reason, that information isn't getting through to everyone who's borrowing at these rates. For instance, Ms. Lewis's interest rate was almost 92%. And had she known at the time that it was that high, there's no way she would have agreed to interest at that rate. And you heard earlier testimony at your informational hearing to the effect that the costs for car title loans have to be exceedingly high because of supposed risk. But as Assembly members Dickinson pointed out, there is very little, if any, risk for the lenders and a very, very high risk for the borrowers. And when people lose their car, there are all kinds of harmful effects that result from that. California is a very car-dependent society, and studies done, for instance, at UCLA have found that people who have cars have much more of an opportunity to get jobs. For instance, they found that the access to jobs increased 5-fold by the ownership of a car. It's like a gateway method of transportation that opens up opportunities for working swing shifts and other shifts that where there may be more opportunities. So it's a devastating thing for people to have their car on the line and to lose their mode of transportation, especially when they're disabled. And in Ms. Lewis's case, the car was sold for way less than she could have gotten had she sold it privately on the market. And we believe that people need to know that when they enter into these transactions and do the math, figure out, am I really better off getting a loan and risking my car, or would it be a better decision to sell the car privately and get a less expensive car? Thank you very much for the...
Thank you. Thank you, Ms. Swanee. Any other witnesses in support?
Mr. Chair and members, my name is Paul Leonard, the California Director of the Center for Responsible Lending. We had written in to support the bill. We've been a longtime supporter and work closely with the author on the bill because we do believe that this is a particularly egregious business lending model that puts borrowers unnecessarily at risk for the collateralized, in fact, over-collateralized loans that are provided through the provisions of a car. We initially supported the idea of a rate cap and still do. We understand that it was removed and it was replaced with a series of amendments. However, we believe the core of those amendments were the underwriting provisions that were established as a reasonable precedent, as a carefully crafted compromise in the context of the small dollar credit pilot program that we heard about earlier, and that Mr. Gutierrez is trying very, very desperately hard to make work in a very thoughtful and sophisticated way. The amendments to the bill would remove the only really binding provision of the underwriting requirements, which is that the loan would not be made if the borrower's debt to income, including the loan, exceeded 50% of the borrower's income. We believe that that's an absolutely critical provision for effective underwriting for these kinds of loans, and as a result, we are withdrawing our support from this particular bill.
Okay. Any other witnesses in support? Any witnesses in opposition? I've been informed that one or more members does have to leave very, very shortly. So if we can make the opposition testimony very, very brief. I understand you have testified before on this issue, but in the interest of time, members did want to get to a vote. Appreciate your concern. What I'm going to do is, in the interest of time, I'll let the opposition speak, and then we'll take questions from members. for either side. Well, yes, we will. Okay, just in the interest of time. So we're going to, if you could make it very brief, members do have to leave, and with the understanding that you had a chance to speak a little bit before. Thank you.
Okay, why don't you go ahead?
My name is Scott Covett. I'm here for the California Financial Services Association. I did not testify earlier. Our members are CFLs, and for the record, our members, title lending is not their primary business. The problem, one of the problems with this measure and the language I received this morning, is that it encompasses a number of loans. In our case, existing customers who have auto loans with our members often come in for additional cash. That cash is typically used for auto repairs, basically a refi. Under that situation, this bill classifies them as title loans, subjects them to tremendous private rights of action, which are included in this bill, including mandatory $10,000 penalties. For example, for our existing customers, if they're in good standing with us, going through the litany of information under this bill is probably unnecessary. We know their credit scores are poor. That's why they're with our members to begin with. But to require all this information is going to delay the process exponentially and, again, subject our members to high litigation. For example, we have to provide them with the consequences for defaulting on the loan. What does that mean? So your credit score is going to be dinged. What else? I guess credit scores may be used for employment purposes. We can't, anything we leave out is going to subject us to litigation. Complete amortization schedule and all costs to the consumer. Well, if a consumer is late on a loan, those costs go up because there are penalties. If they pay early, their costs will go down. Again, we're wrong, we're sued. I mean, item after item after item subjects us to litigation for something that we are doing. We're making a profit on it, but it's not our primary source of business. These people need money. They have no other options. They need it in a hurry. It seems unnecessary at best, and it's a judgment call on the business based on their prior history with this employee. So for these reasons and others, we do oppose the bill.
Okay. Any new statements of opposition?
Mr. Chair and members, Joanne Betancourt representing the Equal Access Auto Lenders of California. Unfortunately, we do regrettably remain opposed. I guess I'll stay here for questions.
Thank you. Mr. Lang, any new issue?
Just a couple, Mr. Chairman. Joe Lang, representing Community Loans. We have been working actually with the Assemblyman and staff over some period of time trying to resolve issues in the bill, and we've gone through various iterations. I'll zero in specifically on just to clarify, my client is not opposed to the non-recourse language in the bill. I'll also probably somewhat sheepishly admit that in discussions with the Assemblyman and staff, we proposed the $10,000 fine because we thought that with proper disclosure and with proper consumer protections in the bill and having that clearly spelled out, that in fact the industry should be responsible and that people don't adhere to those should in fact be subject to a substantial fine. Where we have problems is in the private right of action that's included in the bill now. And that does a couple of things. One, relative to the requirement now in the bill that credit reports be used to determine the borrower's ability to pay. Essentially, first of all, we don't require credit reports by and large by now because we know that their credit scores are low. By mandating that we request a credit score, you're actually penalizing the consumer because that will just depress their low credit score that much more by us having to A, make that inquiry. B, by putting the private right of action as a part of our underwriting, we will get a credit score and we'll try to determine whether that person has the ability to pay or not. If we make a wrong judgment based on a credit score, now all of a sudden that private right of action is going to come in and say, well, you used the wrong judgment because clearly he had or she had a credit score of 580. You should have never made that loan in the first place. It's the private right of action that cascades all these various things. I don't think you want us to have to require to use a credit report for underwriting. At the end of the day, that means we probably won't be able to make a loan. Secondly, it subjects us to the lawsuit. The third element that we're concerned about is the changes in the repossession law. And again, that's where the private right of action comes in. We are sent bills for the storage and fees that we incur when vehicles are repossessed, that we try to recover when the vehicle is sold. If somehow somebody makes a mistake in calculating that storage fee, it then makes us subject to being sued based on a third party's mistake. And so a good part of this issue would be taken away by eliminating the third party, eliminate the requirement for using the credit score as a basis for making the loan.
All right. I'd like to entertain questions from the committee on either the opposition or the support. Mr. Morrell? Okay. All right. Ms. Torres, did you have a question for either side? Mr. Gatto, do you have a question for either side? Okay. With that having said, thank you for your testimony. Would you like to close?
Thank you, Mr. Chairman. I appreciate the comments of the opposition. I think, as Mr. Lang indicated, we have had a lot of discussions over time trying to find an accommodation, and I regret that we haven't yet done that, although should the bill continue to have life and breathe, I would be happy to commit to continue to work with the industry to try to find that landing spot that all can agree on. I would just like to say one quick word about private right of action. This is not an anomaly. This is not unusual. We have private rights of action and a host of our consumer protection statutes. It doesn't mean that lawsuits over smaller frivolous matters predominate. It does not clog the courts. And in fact, consumer litigation is actually going down. And so if we're going to have the opportunity for meaningful substance to the legislation, we have to give consumers some avenue for redress in the case of violations. If we wanted to try to tailor the private right of action, we could engage in discussions on that. But I think it is actually an essential piece of the legislation in order to allow consumers, who we all represent, our constituents, to have access to justice. And I appreciate your time, Mr. Chairman, those of you of the committee who've been able to last throughout the duration. And I would respectfully ask for an aye vote.
Thank you. Do we have a motion? I will make that motion as they do pass as amended, and I understand the author of the bill has taken the amendments as outlined in the committee analysis. I want to thank the Assembly member for working with the committee. As you know, this is a 2-year bill, and initially when it was heard, or at least proposed for this committee, there were some concerns, and I think that the Assembly member and certainly I have certainly learned a lot more about the very many complex issues that a bill like this does raise. And so with that in mind, I understand that there are the amendments. If anybody has any question about it, is reflected in the analysis and the mock-up. They deal with the elimination of the debt-to-income ratio, the elimination of the prohibition that a licensee could not report a negative payment to credit reporting companies. They clarify that a licensee must retain a signed copy of the disclosure document. They clarify what is necessary to ensure the borrower has the ability to repay the loan, and other technical changes. I understand that even with these amendments, the opposition is still opposed. This is an area of tremendous concern, and I think what it represents to me is an attempt by a legislator to wade in there to determine whether or not there is a better way, and I applaud you for that. I'm speaking because I don't hear a second. Is there a second? Sergeants, have you called the asked member? I do not hear a second. I'm not sure if the members that are absent are voting with their absence. We'll wait a couple seconds more. Did any members want to make a comment before we entertain any further business here? Or indicate why there's a lack of a second?
The bill is still in mock-up form. You still have a long way to go. I think while there may be some issues that could and should be addressed, I don't think that we're there yet. But thank you for the opportunity to have a hearing and continue to dialogue on this issue.
So I think my colleague, Ms. Torres, said it right, that I think that I applaud you for working in this area, and I think there's a lot of work to be done, but I just don't think we're there yet. I also take issue with some of the things you said about there being no risk. I mean, every business has risk. If there was no risk in this business, I mean, then I think there would be people waiting to line up at the door and undercut somebody by 10% or 20% and dive into this industry. There's risk that a car could be taken out of state, that it could be stripped, that it could be stolen, that it could be crashed. I mean, there's risks in any business, and I think that we have to continue to work through some of these issues, and I think we'll get there at some point, but just not prepared to support it today. Thank you.
Thank you. Stora?
You'd do me a great favor if you would. I'd love to see a contract on one of these that currently has, as well as it with the amortization schedules in the whole enchilada. If I could get a copy of that, I'd love to just. Sure. Yeah, I'd be grateful for that. Sure. Thank you.
Okay. Ruling of the chair is that unfortunately the bill fails for lack of a second. Applaud all the efforts and want to especially thank my staff, particularly Mark Farouk, who spent an extraordinary amount of time on this. Also want to thank Ms. O'Malley, and welcome back to you, Tiffany. So the Assembly Banking Committee Marathon Committee is hereby adjourned.